This is a modification of problem 6-19 in your textbook. We're going to go ahead and build a worksheet that answers that problem and puts together sensitivity analysis tables. As always, the green data fields are input fields, and all of the yellow fields need to have Excel formulas. Let's begin by calculating our contribution margin ratio. The first thing we need to pick up is our selling price of $20 per unit and our variable cost of $8 per unit. This means we have a contribution margin of 20 minus 8, or $12 per unit. Our contribution margin ratio then is our $12 per unit contribution margin divided by our $20 selling price. Our break-even point in sales, we need to begin by picking up our fixed expenses of $180,000. If we divide that by our contribution margin ratio, which was 60%, we can calculate our break-even level of sales. So 180 divided by 60%. Our break-even level of sales is $300,000. How much will our net operating income and our contribution margin increase if we have a $20,000 increase in sales? We need to take our $20,000 increase in sales and multiply it by our 60% contribution margin, and we see our contribution margin will increase by $12,000. Since fixed costs remain constant at 0, our net operating income will also increase by $12,000. Let's put together a contribution margin income statement for last year. Our sales were our 20,000 units times our $20 per unit selling price. Our variable cost are $8 per unit times 20,000 units. And our contribution margin is sales minus our variable cost. We have a contribution margin of $240,000. We need to subtract from that our fixed costs, which were $180,000. And when we do that, we end up with a net operating income of $60,000. The next thing we're going to do is put together some data tables to show how our net operating income will change if we change our selling price, our variable cost, our fixed cost, or our number of units. At the top of our table, we need to link to the cell we're interested in, which in this case is our net operating income. Then to complete our data table, we highlight, in this case, cells G31 through H42. We include all of our data and the item we're interested in at the top. From there we go to Data on the main menu. We select What If and Data Tables. Now our data tables have been arranged in the form of a column. Our input fields here are in a column. We want to take these selling prices and input them into our selling price field, which is cell B3. Now we hit OK, and we can see how our net operating income would change based on a change in our selling price. As our selling price goes up, as expected, our net operating income will go up. Let's now do the same thing for our variable cost. Again, link to our net operating income, highlight the cell that includes that net operating income, and the column that includes our variable cost per unit. Go up to Data, What If, Data Tables. We have our column inputs, and we want to put those into cell, in this case, B4. And again, as our variable cost per unit go up, our net operating income goes down. Let's look and see how our fixed cost will impact our break-even. Again, let's pick up our net operating income, highlight our net operating income and our fixed cost inputs, Data, What If, Data Tables, again columns. We want to take this fixed cost and we want to substitute that in cell B5. And we can see, based on this, our break-even would occur at a fixed cost of $240,000, which is to be expected since that's our current contribution margin. Let's finally again do our net operating income based on changes in units. again, linking to our net operating income, highlight cells, go up to our main menu, data, what if, data table. We want, again, we have column inputs. We want to put these unit cells into cell B7. And when we do that, we can see we would have had a break-even point at 15,000 units. 15,000 units times our current selling price of $20 per unit agrees with the break-even we calculated in part number 2. All right, let's go ahead and compute our degree of operating leverage. Our degree of operating leverage is our contribution margin of 240,000 divided by our net operating income of 60,000. Our degree of operating leverage is 4. Therefore, if the company's president expects a 10% increase in sales, we would expect net operating income to increase by 10% times 4 by 40%. Let's calculate our degree of operating leverage. Our degree of operating leverage is equal to our contribution margin divided by our net operating income. It's 4. If the company expects sales to increase by 10%, this means our net operating income should increase by 10% times our degree of operating leverage. It should increase by 40%. Moving down, let's consider item 6. Let's pick up first our unit sales from last year. That's from above. That, by the way, doesn't agree necessarily with the figure in the textbook. We're going to use our 20,000. And we're asked to evaluate how a $1 change in our sales commissions, in other words, if we increased our sales commissions by $1, and we expect that to result in a 25% increase in sales, how would that impact our contribution margin? Let's begin by picking up our selling price per unit that we had above, $20. A $1 increase in our variable cost will mean our variable cost per unit is, and again, we want to have a formula here, our $1 increase plus our current variable cost up in cell B4. We have a variable cost of $9 per unit and a contribution margin per unit then of $11. Our projected sales, if we have a 25% increase, will be current sales times the quantity, 1 plus 25%. Our projected sales then are $25,000. Our projected contribution margin then would be 25,000 units times a contribution margin per unit of $11. And we can compare that to last year's contribution margin, which was $240,000. And we can see our contribution margin then would increase, since we have no change in fixed cost. It would increase by $35,000.